For decades, global trade was the heartbeat of the world economy, moving everything from microchips to coffee across continents at lightning speed. But now, that rhythm is fading. The World Bank warns trade growth could sink to barely 1.8%, its weakest pace in years. Container ships are sailing half empty, tariffs are rising again, and new geopolitical fractures are quietly choking the arteries of global commerce. If 2025 was the slowdown, 2026 could be the freeze. Factories that depend on steady imports may soon run dry. Prices for essentials, from food to fuel, could spike without warning. The global trade machine that once built prosperity may now be building pressure. So the question is, what happens when the world's supply lines stop moving? Because if trade collapses, everything else, jobs, prices, and stability, follows. When you look at global trade, until recently, it seemed unstoppable. Containers sailed across oceans, supply chains wrapped the world like arteries, and economic growth rode on a wave of goods, services, and cross-border investment. But now, the rhythm is faltering. According to the World Bank, global trade growth is forecast to slow from 3.4% in 2024 to only 1.8% in 2025. And while there's hope for a slight rebound to around 2.4% in 2026, the system's foundations are clearly shaken. The stage is set for a global crash course in the fragility of trade.
Imagine a series of highways carrying goods, raw materials, finished products, electronics, food, and suddenly many of those roads begin to narrow, tolls appear, and speed limits tighten. That's essentially what's happening in 2025 and 2026. Trade volumes aren't rising as they once were, and the ripple effects hit every economy, large and small. Global institutions warn that a sudden escalation in trade tensions could cause trade to seize up entirely, leading to a collapsing confidence. The human pain behind these numbers is rarely shown. Factories in Germany wait for parts that never arrive. African exporters lose buyers as tariffs climb, and American retailers hike prices because shipping costs spike and materials shrink. Ordinary consumers feel it in their wallets, even if headlines speak only of percentages. That's the paradox. Trade seems like an abstract macro metric, yet it directly touches every household. It affects your grocery bill, your job security, your region's export market. Let's look at three main forces behind this slowdown, the ones that could turn a slowdown into a full freeze. The first is policy uncertainty and tariff friction. Trade thrives on predictability. You build a factory, plan to export, and count on steady imports. That system is under siege. Tariffs and retaliatory measures are rising again. In 2024, world trade was still growing, but by 2025, growth in goods import volumes had dropped from nearly 7% to below 3%. When policy becomes unpredictable, companies stop investing, contracts are delayed, and supply corridors tighten.
The second force is the reconfiguration of global supply chains. The era of just-in-time global production is under pressure. Companies are reshoring, nearshoring, or diversifying production away from single sources of risk. But those shifts take time, and in the transition, trade volumes weaken. Sectors like electronics and machinery depend on intricate global networks. When one link falters, the entire chain slows. The new geopolitics of tech rivalries and export controls add further friction. The risk of supply lines freezing is no longer theoretical, it's becoming plausible. The third force is weak demand and investment. Trade depends on people and companies buying things. The world economy itself is slowing. Global GDP growth is projected to fall toward 2.3% in 2025, with only a modest recovery after that. When global demand is weak, imports shrink, exports falter, and trade volumes contract. Emerging and developing economies feel this pain most. Investment is falling, debt burdens are high, and many depend on trade for jobs and fiscal stability. All of these forces are now combining. If trade growth halts or dips further, the network that moves the world, manufacturing, logistics, distribution, can jam. And that brings us to the bigger question: why 2026 could become the freeze year. Yes, 2025 shows the stumble, but 2026 holds the real danger. The delays and disruptions already building up this year will carry over. Companies postponing orders now will see even weaker trade flows next year. Institutions are warning of the same risk, that the world could enter 2026 with trade volumes barely moving or even contracting.
If that happens, three consequences follow quickly. Manufacturing hubs face shortages of parts, forcing production cuts. Retail and service sectors see costs rise, pushing prices higher for consumers. Emerging market exporters lose access to global markets, leading to job losses and currency pressure. The domino effect would spread fast. A factory shutdown in Asia could mean empty shelves in the United States or Europe. Global trade has always been the quiet stabilizer of prosperity. It doesn't make headlines like wars or elections, but it keeps the system humming. Yet when that stabilizer begins to shake, the whole structure starts to rattle. The numbers may sound small, 1 or 2 percentage points of growth, but in a $30 trillion trade system, those percentages are the difference between stability and strain. The global trade engine isn't just slowing, it's being redesigned while still running. And the risk is that in the process, it may seize. The next part of this story will explore who stands to lose the most if trade freezes, and whether the world still has the tools to keep its arteries open. The slowdown in global trade isn't an accident. It's a chain reaction built over years of quiet strain and short-term decisions that never healed. To understand why 2026 could see the system freeze, we have to trace how the machinery itself began grinding down.
For most of the past 2 decades, world trade grew nearly twice as fast as global GDP. That was the golden rhythm of globalization. More factories, more ships, more wealth. But by 2025, that rhythm had broken. The World Bank projects global trade growth at barely 1.8% in 2025, half the long-term average. And what makes this different from a typical slump is that it's structural, not cyclical. It's not just weaker demand, it's the wiring of trade itself that's changing. The first mechanical fault lies in fragmentation. The world economy is splitting into competing zones of influence. The United States and China, once the twin anchors of global trade, now build rival ecosystems. The US subsidizes its own industries through domestic manufacturing acts and green incentives, while China accelerates state-backed technology dominance. Both nations now trade less with each other and more within their political or regional circles. This means less global integration and more duplication. 2 supply chains doing the same work in parallel, each less efficient than the shared system they replaced. The second fault is in logistics and cost. After the pandemic, shipping recovered but never normalized. Freight rates remained 20 to 30% above pre-2020 levels. Energy price volatility, labor shortages at ports, and new insurance risks have turned shipping into an unpredictable expense. The Panama Canal's drought restrictions cut daily vessel traffic by almost half. Red Sea tensions added longer detours and higher insurance fees. Each of these disruptions adds a few days or a few dollars, but multiplied across millions of containers, they become billions of dollars in hidden costs.
The third fault is political self-protection. Protectionism has come back under new names: strategic autonomy, friendshoring, resilience. Governments see it as risk management, but for trade, it's friction. The World Bank counts more than twice as many trade restrictions in 2025 as in 2019. Export controls on chips and critical minerals, tariffs on green goods, carbon border taxes, each step justified in isolation, but together they form a wall around global commerce. The fourth fault lies in capital and demand. High interest rates have cooled investment worldwide. Companies delay new plants, shipping lines avoid expansion, and households tighten spending. Weak investment feeds weak trade. Fewer machines ordered, fewer goods shipped, fewer services exchanged. For emerging markets, this is particularly dangerous. Many depend on exports to pay foreign debt. When trade slows, currencies wobble, reserves fall, and governments face hard fiscal choices. All these pressures converge in the same place: the shipping container. Once a symbol of seamless globalization, it now represents its fragility. Every container is more expensive to move, more regulated, and more delayed. When multiplied across the global system, that friction becomes drag, and drag becomes paralysis. The numbers tell the story clearly. Global merchandise trade volume grew about 2.7% in 2024. It will likely fall below 2% in 2025, and early projections suggest only a shallow recovery in 2026, far below the pace needed to sustain global growth. Services trade, once resilient, is also slowing as travel, transport, and outsourcing face cost spikes. The arteries of globalization are narrowing, even if they haven't yet closed.
But there's a more subtle mechanism behind this freeze: the loss of confidence. Trade runs on trust that contracts will be honored, payments will clear, borders will stay open, and shipping lanes will remain safe. When governments weaponize trade or when ships face attacks on open waters, that trust erodes. Once it's gone, even cheap credit or tariff cuts can't restart momentum. By late 2025, companies are already hedging their bets. Some build extra inventories, others shorten supply chains, or pull back from foreign contracts. Individually, these moves look prudent. Collectively, they shrink the volume of world trade. The great globalization engine that once multiplied efficiency is now running in reverse, each nation optimizing for safety, not speed. The system is still moving, but more slowly, with more noise and less confidence. And like any complex machine under strain, one more shock, a financial crisis, a conflict, or a natural disaster could cause it to seize. This is how the freeze begins, not with a dramatic crash, but with the steady tightening of bolts no one notices until the gears stop turning. The warning lights are flashing across every major corridor, and if the world doesn't act, 2026 may be remembered as the year global trade finally stopped expanding and started breaking apart. By the time 2026 unfolds, the slowdown is no longer a warning, it's reality. Ships still move, ports still operate, but the pulse of global trade has slowed to a cautious, irregular beat. Every shipment is a question mark, every delivery a small victory. What was once routine, a product traveling from one end of the world to the other, now feels uncertain, expensive, and fragile.
The consequences are everywhere, visible and invisible. The cost of living rises quietly as imported goods become scarcer. Inflation, thought to be tamed, lingers because trade no longer absorbs shocks the way it used to. For ordinary households, it means higher prices for essentials, from electronics to food staples, and fewer options on the shelves. For businesses, it means tighter margins and harder decisions, whether to cut jobs, raise prices, or relocate production closer to home. Industries that built their strength on global scale are the first to feel the chill. Automotive manufacturers dependent on cross-border parts see assembly lines halt for weeks at a time. Electronics producers face chip shortages again, not because of pandemics, but because of trade friction. Even agriculture, which once flowed freely across continents, feels the pinch as fertilizer, fuel, and shipping costs climb. Every link in the chain becomes an exposure point. The geopolitical map shifts. Countries that used to dominate trade routes lose leverage as others adapt faster. The United States and China continue to guard their own spheres, but middle economies, India, Vietnam, Mexico, Indonesia, emerge as regional anchors. They trade more within Asia and the Americas, forming smaller, self-sustaining loops. Europe pushes deeper into Africa and the Mediterranean, seeking proximity over global reach. What emerges is not the death of globalization, but its mutation, a world of regional trade blocs, each orbiting its own economic sun.
For developing nations, the stakes are existential. Many built their growth models on exporting to richer markets. Now, with demand weaker and freight costlier, their earnings collapse. Debt grows heavier, currencies weaken, and the flow of foreign investment slows. Some countries begin to rely more on raw materials and less on manufactured exports, a step backward in industrial progress. The promise of globalization, that open trade would lift all boats, feels distant again. Yet out of this paralysis comes adaptation. Companies begin investing in redundancy instead of efficiency, 2 suppliers instead of 1, regional warehouses instead of global hubs. Automation accelerates as firms try to offset higher labor and shipping costs. Digital trade grows, not in goods, but in services, data, design, and artificial intelligence. The physical arteries of trade may be clogged, but the digital bloodstream expands in their place. Governments, too, start to redefine success. Growth becomes less about scale and more about stability. Resilience becomes a new economic religion. Nations invest in domestic infrastructure, renewable energy, and supply security. The idea of endless consumption gives way to something slower and perhaps more sustainable. The world begins to learn what an economy looks like when it values independence as much as integration. But there's a cost to this new balance. The efficiency that made goods cheaper and economies richer is gone. Living standards adjust to a slower rhythm. For many, it feels like decline. For others, like a correction. The age of abundance gives way to the age of adjustment.
As 2026 closes, the tone of global conversation shifts. Leaders stop talking about restarting globalization and start talking about rebuilding trust. Trade won't disappear. It never does, but it will move differently. Less about speed, more about certainty. Less about scale, more about connection. The freeze in the end may not mark the death of global trade, but its transformation. The world that emerges will be smaller, slower, and more self-reliant, yet perhaps more aware of its interdependence. Because every border closed in fear will eventually need to open again in necessity. The real story of 2026 won't be how trade collapsed, it will be how humanity learned to move differently when the system that connected it began to slow. Trade built the modern world, but now it forces the world to rebuild itself. The chill of 2026 may fade, but the lessons it leaves behind will shape how the next era of globalization begins, not as a race, but as a reckoning.